here. We've got some good presentations for you this morning to talk about livestock and crops and what's happening in Texas. And we want to thank our sponsors, as always, which is the Texas Sorghum, the Cotton Board, and the Texas Corn Producers Board that help us bring this to you every month. We're going to kick things off quickly this morning with the livestock update with Dr. David Anderson, our extension economist there in College Station with Texas A&M AgriLife Extension. And David, let us know what we're doing right and what we're doing wrong in livestock. Thank you, sir.
Well, good morning. Thanks for having me on with you guys. I will, in theory, share my screen.
We can see it.
There it is. Okay.
Yes, sir.
So, I really want to talk about prices this morning, and I'll stick to just cattle today, and really kind of look at some prices, what's going on, why here as we get to the end of the year. Then I'm going to jump over and show a little bit of data and talk a little bit about some of the screwworm activity that's going on. That's certainly been in the news lately, and I think that's a pretty important thing. It's not on us yet, but I think it's a pretty important thing in the market. So with that, let's jump in. I got about 4 charts I want to show that are prices, and I'm going to start with some 400 to 500 pound number one steer calves, Southern Plains. And I think the thing worth pointing out is just look at the last few weeks here. We've had a tremendous sharp run up. In fact, we've hit some, our high point for the year. And we do tend to see an increase in prices as we get to the end of the year. We're over the big fall runs of calves. So we get past that kind of big supply in the market and we get a little increase. We've had a much larger than kind of normal seasonal increase this year. One is, I think we had a run of calves that was early. We also had, I think, some poor. I'll let my colleague Mark Welch talk about this, but I think we would. So I'll step on his toes a little bit in the grains, but I'll say I think we had, some drought conditions in wheat pasture country that led to some really late development, which puts off grazing. So we get past the fall run of calves. We didn't have that demand. Then we got some rain, and the prospects for winter grazing improved dramatically. And so all of a sudden, we get a surge in demand for calves as well going on. And so I think that's driven those calf prices higher, both kind of a little bit of a dwindling supply side and a boost in demand. I think the other thing we might think about in this too is this also some evidence in terms of cutting back supplies for sale? Is that some evidence of maybe some heifers being held back? And I don't think we really know the answer to that. If we look at some available data, if we look at some anecdotal stuff from auctions, at least further north than us here, there might be something to that. At least maybe fewer heifers in these runs of calves at auctions. In some places further north is where I've seen those kind of anecdotal evidence going on. So, I want to point that out and just think we can think about this going forward is certainly some demand, but also tighter supplies. I think it's also, these and the next ones are going to be pretty indicative of what's going to happen if we really start to respond to high prices by holding back heifers to expand the cow herd. I think we can expect even higher prices than these next year or beyond when we finally get to that point that we see that happening. So certainly I think that's some good news on the cattle side of things. We see the same thing if we look to 5 to 6s. Higher prices as well. Again, our high point for the year as well. And so, I think, that's certainly the same considerations there. I might suggest too, I think if we look back historically at times in the cattle cycle, we tend to see these higher prices late in the year when we're declining the herd. Because the fall runs reflect the number of cows we had having calves early in the year, and so as those numbers come down, all of a sudden we get tighter supplies later in the year. So I think there's just some kind of normal, kind of seasonal, cyclical evidence supporting these underlying prices. But certainly, I think we probably ought to be thinking about higher prices next year than this year as well. And I should say too, I have not gone back to see if I could find the last time we hit the high price point for the year. In late November, early December. That's not very often. Although you'll take a look at that dotted line for 2023, and we did it last year too. So um, it does happen from time to time. But again, these same demand and supply factors happening going on. Look at the fed cattle market. Fed cattle's gotten back over $1.90, $1.91. That's supporting feeder and calf prices as well. We've got a cattle on feed report that will come out on Friday of this week. And my pre-report estimates, I've got placements down 4%. Marketing's down about 1.5%, which leaves me with cattle on feed just under where we were a year ago. So again, in terms of a number of mouths to feed out there in feedlots, relatively large numbers compared to a year ago. Sitting here thinking about it, I might be a little heavy on my placements. I think if we looked at across all the market analysts, I'm a little on the higher side for placements. And so, but again, relative to a year ago, plenty of mouths there to consume, at least consume some corn anyway. So fed cattle prices building here at the year end too. I think we continue to have good demand for beef. And so prices are reflecting some of that going on as well. One last one, and that's on our old cows. We have a seasonal pattern. Prices tend to peak kind of May, June. This year is no exception. When you think about it, the big runs of cull cows on the beef side happen late in the year. And then we get this demand pull for grilling season starting there in the spring, drives those prices up. As that ebbs, prices tend to decline seasonally, and we have that going on. I think this seasonal pattern will be with us for next year as well, but at a higher level, with fewer cows, tighter supplies. Uh, I think the opportunity there is for some higher prices on the cull cow side, as long as our consumers, including yours truly here, keeps eating cheeseburgers. Where the demand for that lean beef, for ground beef, will still be with us. I want to hit one other thing, and that is if we look at weights, these are steer dressed weights. Um, that's been one of the big stories. We've had record large weights, pushing 960 pounds on the steer side. We've actually seen a little bit of decline here. One of the big questions is, can we see this kind of year over year growth? Does it pull back to something like the year before, or towards this 5-year average? I think heavier weights has been the long-term trend, and that's likely going to be here with us forever. I do think one factor, particularly into and later in 2025, may work in our favor on pulling this down, and that is that as numbers tighten up, uh, then to keep that throughput going through a plant, what we end up with is days on feed could conceivably shorten, which would bring these weights down dramatically from the levels they've been at, which then cuts beef production pretty dramatically. So some of our beef production for 2025, I think certainly depends on these weights. And weights are how we've gotten fed beef production at or greater than the year before, is just simply because of weights. And so, I think one of the things we might watch for is continued large weights, maybe close that gap between this year and last year, and the new year in 2024. We have the opportunity to see those gaps close, but it's because of tighter numbers and pulling animals through a little quicker, then pulls the weights down. So I think that's been a pretty fascinating factor this year in the cattle market and the beef market, that we might look at going forward. So I thought I'd do a little update there. I want to say something about screw worms, and I'm going to, just as an economist, there's certainly a lot of all of our industry groups are involved. Certainly, APHIS with USDA is working pretty diligently to make sure we keep those critters away from us. Now, there was a cow that was found with screw worms down in Chiapas, the state of Mexico that borders Guatemala. It's a long way to Guatemala or to Chiapas, Mexico, and let's keep everybody wants to keep those things way down there. But I thought what I'd do is just show for a second, we might think about kind of the bigger picture here. We've got these are annual cattle imports from Mexico. My 2024, you'll see that 24 is about the same as 2023, a little bit less. That 2024, though, I've got that up through November when they stopped imports. And so for the last couple of weeks, we've had zero cattle coming across. The restrictions on imports of cattle involve a lot more inspection, time, and we'll see how this plays out in terms of stopping numbers. But in the last couple of weeks, we've certainly had zero come across. But what that should tell us too is that, you know, as we look historically, our level of imports are not unusual. 24 would have been higher than 2023 if imports would not have been stopped. But we import cattle from Mexico all the time. They go to grass on ranches in Texas. They go straight to feedlots in many places, and so they become a pretty important part of our cattle numbers in terms of feeder cattle numbers and beef production. We look back across these years, we could think of something like 3.5% equivalent of our own calf crop, or the number of head coming from Mexico. This year of, say, feedlot placements, placements coming from Mexico have been bigger. They've been about 5% roughly of feedlot placements. And so I think that just kind of puts it in context. What kind of numbers are we talking about? And if I put one more on here, these are our weekly feeder cattle imports from Mexico. And I want to point out a couple of things here. One is, if we focus on this red line, that's a 5-year average. It's pretty easy to see the seasonality of imports. And, stopping imports comes at what is historically the biggest time of the year for imports coming from Mexico, because they're going to winter grazing or they're going to feedlots. And if you think about, biological production down there as well, that's when they have probably more supplies to come up here as well. So you think about when we need cattle, when we're going to use those cattle, when they've got cattle for sale, and it really makes, I think this seasonal pattern makes some sense. But you can see on that chart, last couple of weeks been zero. And we might have expected some 40,000 head a week coming in those 2 weeks. And as we go into December, again, some fairly large numbers like that. And so we might certainly think maybe part of this run up in calf prices that we've had, a portion of that is probably due to fewer cattle coming from Mexico. And so we can think about that as well. But I think that data sort of puts it in some context of where we are and what's going on. Let me say a couple of things about kind of economics and economic analysis. We certainly think about decreasing the available number of calves, decreasing feedlot supplies for them to place. There's certainly a value-added agriculture component that's lost there. Yet at the same time, we could think about on the ranch side some higher calf prices. If we got some calves for sale and haven't sold them already, I think there is some potential for some seasonal impact on prices. If this is just a delay in imports, then we'll get those cattle later on, maybe kind of pressure prices a little bit later on then. I think a lot of this remains to be seen, but just thinking through this, I think we got a couple other considerations. This restriction in imports is certainly hitting at a time when we have relatively few supplies of cattle. And so the price impacts may be different than in times when we're pretty flush. So I think that's worth considering. I think going on is, if we think about, the past, and we kind of take a historical look at screwworms and what folks had to do to keep their cattle healthy and alive. Same goes for sheep and goats. I think there's plenty of evidence that our deer numbers really exploded after we had the screwworm eradication program. And if you think about whether it's hunting or deer farms, deer breeding, or exotic wildlife today, we didn't have a bunch of that stuff way back when we had screwworms. And so the potential for economic impact, I think, is much greater, much different than maybe we have looked at in the past. So I thought I'd just throw that out there, I'll make one other reference. I wrote this up in something. I put a book reference. If you've read the book by Elmer Kelton called "The Good Old Boys," the main character spends a whole bunch of time every day roping calves and checking for screw worms and doctoring and doing the same thing the next day. And so I thought that's a heck of a good book and a nice little something relaxing to read maybe for the holidays. So anyway, with that, that's my last slide. Uh, I'll see if I can bail out of this sharing and maybe I did it.
You did it. Yeah. You did it.
Hey, all right.
Yes, sir. Thank you, David, very much. That's good, up to date, impactful information. Thank you for that. Well, welcome, John. We hear you. If you don't mind moving your microphone, that would help us out a little bit. We're going to move right into Dr. Mark Welch, who's an extension economist with us with Texas A&M AgriLife Extension out of College Station as well, talk about the grain. So, Mark, if you can share your screen with us and get started, it's all yours.
You betcha, Matt. Appreciate this. And let's make sure, hope we have chosen the right screen to share. We'll start a slideshow. And great to be with you this morning. Appreciate y'all putting this opportunity together for us every month.
You bet. We see it.
All right. Of course, typically in this time frame, we talk about those fundamental factors that result in a grain price at any given time or any given season. The factors of supply on one side, the factors of demand on the other, and we'll look very briefly at kind of how that shaped out for 2024, and then how this might look as we start taking an early look at 2025. And in 2024, I think of course, the continued economic stress on farms and from high cost and relatively low prices, creating tight margins, that was with us in 2024. It doesn't look like that's going to change for 25. But what really accentuated that problem, the bottom bullet being we had good weather through most of the United States in the grain producing areas, and that resulted that the factors of supply for most of our grain crops increased more than the factors of demand. And that's a pretty simple recipe to put downward pressure on prices when that happens. And just put together a balance sheet comparing the last marketing year, 23-24, to the estimates, what we thought in May, kind of how the early season prospects were looking, and then updated for the 24 marketing year with the December numbers from USDA. And I think there's some pretty interesting things that transpired there that not only kind of explain what happened year to year as we came into 24, but now maybe just setting a tone for where we're heading as we start making plans for 2025. First of all, in 23, we had an all-time record high corn production, a record high yield at that time on 94.6 million acres, which is a pretty big acreage number, set a record for production. Back in May, we were using a yield of 181 bushels, which is another, of course, obviously a record high, but on fewer acres. So we're looking at a production number coming in lower, but would still increase the supply somewhat. By the time we get into December, we've got even a bigger production number. However, USDA reduced the carryover from the previous marketing year. We thought we were going to carry over 2 billion bushels from 23. Now we're only carrying over about 1.76 billion bushels. So that kind of moderates a little bit the supply back. Still a big number, carrying supply forward of just under 17 billion bushels. But the big change was in our use numbers. In May, we were looking at use of 14.8 billion bushels, down from just over 14.9. USDA in that December WASDE raised their export numbers. And with more of our crop going to and finding a home in the export marketplace, that increased use and pulled our ending stocks number. We thought we were going to carry over another 2 billion bushels of corn at the end of this marketing year. We're actually looking now at a lower carryover for this crop year than we had for that 23-24 year. And so again, fundamentally, that's setting a pretty good stage for where we may be headed in 2025. Doesn't help us with our 24 prices, obviously, and we'll look at that here in just a second. But perhaps it does set a tone or set the stage for something a little more positive heading into 2025. And just looking very briefly at what those export numbers look like for our major grains. This is for wheat. USDA for the 24-25 marketing year. This ends on May the 31st for wheat. 850 million bushels. That's up 25 million bushels in the December report. Those targets along the way is kind of where we ought to be in the marketing year. By the end of December, we should have 75% of that total on the books. Well, we're right on track to hit that. And again, that's an elevated number from where we were in November. A note as well is our major trading partners when it comes to wheat. It takes about 4 nations to get to 50% market share for U.S. wheat, number one being Mexico, Philippines, Korea, and Japan. And then, of course, smaller numbers. One interesting thing to note is a very small percentage at this point going to China. China has not been a major participant in the U.S. wheat market this current marketing year. Let's look at corn. USDA raised that target substantially in the December WASDE and now 2.475 billion bushels. Typically by the end of December, we would be at 55% of that target. We're well ahead of those numbers. Again, well on pace to hit that new target established by USDA. It only takes 2 customers to get to that 50% market share when it comes to corn, Mexico and Japan. You look at soybeans, again, a very strong pace of soybean sales in this current marketing year. Interestingly, USDA raised the target for corn with this strong pace of sales early in the year. USDA did not raise the total in the December WASDE for U.S. soybean exports. And so whether that's yet to come, whether that's factoring in that perhaps this is just early season buying with really cheap prices, you can get a good deal right now on soybeans. So our export customers are just loading up now at abundant and cheap supplies of soybeans. But again, a very strong pace so far in this marketing year, and it only takes 1 customer basically to get to that 50% level when it comes to soybeans, and those, of course, go to China. Europe and Mexico would be other 2 major buyers of U.S. soybeans. And you look at the grain sorghum market, it's China. That's the importer of sorghum in the world, and the U.S. is the primary exporter. And sorghum really hasn't taken off yet this year. A pretty healthy export projected total, 220 million bushels is a good number from USDA. But again, the kind of the targets along the way, we haven't really yet begun to make a serious run at those at this point. But again, USDA held the number steady, and so perhaps anticipating some activity in that market to pick up after we get around the first of the year. And so again, that sets the stage for much of the price activity, I think, moving forward. But this is kind of looking back. The black line is the closing price of the December 24 corn futures contract in 2024. So from early January until that contract expired here just this last week, you can see that price movement in corn. The red dotted line would be the seasonal pattern for that contract. Typically, you'd see that increase from January up through about mid-June. Then, as we know with the acres, we've got a better handle on weather, what happened in South America in the spring. Prices typically then fall off through the summer, bottom out in late September, and then a little late season rally kind of to wrap up that contract period. And we followed very, very closely that pattern throughout 2024, with the exception, we were a little weak getting started, but then we just ran those about a month early. We hit the peak in May, not June. We hit the bottom in August, not September. And now this, late season kind of a little bit of post-harvest rally, again, right about on track to what you would expect. So again, a very interesting seasonal pattern. It took a while before we caught any kind of upward momentum last year, and I appreciate David your comment on maybe finding a good book this time of year, and I like Elmer Kelton a lot too. a year ago at some of the major marketing programs, and this was at the Commodity Classic, our friend from the University of Minnesota, Ed Ussett, when grain prices were doing what you're seeing on that black line, this was January all the way into about mid-February before we kind of caught him market strength. His recommendation at the Commodity Classic a year ago was go find a good book. You're not going to sell anything right now. You're waiting for the market to find its legs, do something. And so he had a reading list. That was his part of his marketing plan with what was going on in the corn market last year, was just go find a good book and just come back to these markets a little later. Well, that can be appropriate advice, I think, from time to time. But I do look at the upward trend we're seeing late in this season, combined with that export demand. Perhaps we are setting a tone for that upward trend as we roll that calendar over into January to find that fundamental strength to give us a little upward price movement, a little bit of hope going into 2025. One factor, of course, for that 25 price is what about acres? We went from 94 million to 90 million acres of corn. What are our prospects now for 2025? This is just a price relationship between the harvest time futures, November soybeans and December corn. And the ratio of those prices that results in about a break-even level of revenue in the Midwest. These are from Illinois crop budgets. Whether you plant soybeans or plant corn, the revenue from those with normal yields is about the same when that price relationship is 2.41. So about 2.4 would be kind of that break-even level. A ratio above that indicates soybean prices are higher relative to corn, and there's more profitability from soybeans. A ratio below 2.4 indicates the price of corn is stronger relative to the price of beans, and at normal yields, you would expect a higher net revenue from planting corn than soybeans. Well, that trend since the 1st of October is sending a pretty clear economic signal as to which crop will be more profitable in 2025. And certainly falling now down below that 2.3 level, that's sending a signal to producers that perhaps there would be more of an economic advantage to planting corn in 2025 than soybeans. So again, if we're looking at a balance sheet projection, if I'm plugging in a number for 2025 for corn acres, that number is going to be higher than it was in 2024. The question is just how much. Early estimates, USDA, for their long-range projections for 2025, they're using 92 million acres. Again, 94.6 in 23, 90.7 in 24, and they're bouncing that back up to 92. I think that's reasonable. A yield of 182 bushels, yeah, given what a normal yield looks like in today's world, that's probably a decent number. You're looking at a supply increase year over year, about 1%, actually a little bit less, a little lower carryover, production up just a little bit higher supply. So what about demand? What can we do on that demand picture? If we leave exports steady where they were in 23, which is what USDA was doing early in these projections, they're looking at an actual supply, a use decline from one marking year to the next. And again, that's supply increasing greater than use, but that's using a relatively low export number. So I think the key for our early season demand projections when it comes to 25, our domestic use is solid. Feed use with those heavier weights, we got to keep feeding that cheap corn. Ethanol kind of steady, hanging on, but it's that export category that I think has the most uncertainty and the opportunity around that in terms of getting that total use number, getting that ending stocks number something more manageable. The current projections from USDA would plug. Here we are with the 2024 crop, about $4.10 a bushel. If we raise that carryover in 2025, as that previous slide indicated, we're looking at prices just below that $4, say $3.90. And so that kind of moves us further to the right in terms of those supplies. But again, that's built on an export projection that is relatively low at this point. So again, I think moving that carryover left or right, sliding on the scale on that x-axis toward higher prices or continuing this low range will depend primarily on exports. And so all that said, my fundamental projections for U.S. grain may get thrown out the window, because I think what's going to drive much of the uncertainty and prospects around that export potential is not coming from the fundamentals of the market, it's coming from politics. What will be the impact of trade changes, relationships, tariffs as we enter the new year under the new administration? Certainly, there's a lot of talk right now of immediate tariffs on our largest trading partners. The previous Trump administration, we were talking about China primarily. As we begin in January of 2025, we're hearing talk of tariffs on Mexico, Canada, as well as China. And if you look at how important those are to our U.S. grains, China is the number one customer when it comes to soybeans and sorghum. Mexico is our number one grain customer for wheat, corn, rice, and they're number three in soybeans. So, you got them all right here. And so certainly these trade aspects are going to be very, very important. If we're going to maintain some upward trustability, how these trade relations and negotiations and tariff applications, how they actually transpire, or then whether they have the impact that they possibly could, given the importance these factors are to our grain markets. And so I really like to use this picture of this slide of a statue that's outside the Federal Trade Commission, commissioned in the 1930s. It's called Man Controlling Trade. Trade is a beast. Trade is a powerful force. And if it's harnessed and used wisely and used well, it can be a tremendous asset, a tremendous partner. Misused or abused, certainly it can have impacts that could have consequences that would not be positive for the growth of the U.S. economy and global trade generally. So I think much of our outlook for agriculture in the 2025 will be influenced by the activity and the specifics we see coming out of the trade area. Otherwise, high cost, tight margins. I think things do continue to look tight and look tough in the ag sector right now. Appreciate the time sharing today. Be around if there's any comments or questions. But again, thanks for making this possible today.
Very good. A lot of good info there, Mark. Appreciate it very much. A lot of uncertainty coming with the new administration. I think everybody's talking about that for sure. So I think we're going to go to John now. I know, John, you're on the road, so you may not have slides, and that's fine too, but we're glad you're with us this morning. Dr. John Robinson, extension economist with Texas A&M AgriLife. And John, go ahead and take it away.
All right. Thank you. Thanks, Matt. Yeah, I'm going to do this the old-fashioned way. I'm pulled over by the side of a foggy highway on the way to College Station. But, a lot of what Mark Welch just said about the dynamics of the grain markets, the same principles will apply to cotton, except that cotton prices have been more disappointing, I think, to people, particularly with the 24 crop. USDA, they publish the same supply and demand estimates. Well, they publish supply and demand estimates like they do for grains every month. They do for cotton. The ones they published in December basically have kind of left a picture it's a continuation of a picture that it kind of explains the low prices that we've been seeing. Let me just say that ICE cotton futures have been trading like 69, 68 cents in the last couple of days. So they're slipping even at the lower end of where they've been trading. They're kind of weakening from there. I can understand that weakness, given the fundamental picture, which is basically that we're adding to the carry-out stocks, we're adding to the leftovers. Even though we didn't have a huge crop, and USDA's been kind of trimming their estimate of the 2024 crop. At one point they were projecting a 17 million bale crop, and they cut that to 14 something, and they've basically been kind of finessing a 14 and something million bale crop. And I don't think there's many surprises left, frankly, with the crop size. None that are going to move the market. They may trim 100,000 bales here or there. They may add 100,000 bales. I think we're kind of zeroing in on the final number, and the surprises are gone. So like grains, the remaining influence is going to be on the demand side, on the trade side. And, our export sales of cotton just haven't been spectacular. We've had one or two that have been really, really notable. Those are weekly export sales numbers. They're published every Thursday for how many bales of U.S. cotton the merchants had sold that week for future delivery. And the numbers that we've been selling have been like 150,000 a week, 200,000 a week. And that's kind of tepid is how my mother would describe that. Just not spectacular, not really strong, not enough to lift the market. So, if it plays out the way USDA's penciled it out, we'll have 3 or 4 million, 3-point-something million bales of ending stocks left at the end of the current marketing year, and that's just nothing that's going to really lift us. And that's not even considering the risks that Dr. Welch was just talking about on the trade side with tariffs. If we get into a renewed trade war, that's going to gum things up even worse than where they are right now. Anyway, long story short, if anybody listening has bales to sell from the 24 crop, the market is not signaling that you should pay for storage, hang on to them, and wait for higher prices. That's definitely not what the market is signaling, because the spread between the March contract that's currently we're trading and the May and the July and even the new crop December, the spread isn't enough to pay for storage. So the market is signaling, go ahead and sell what you've got, and then think about next year. So let me talk about next year. The way I'm sizing it up, I could easily see, because grain prices aren't that good as competing prices, I can see us planting 11 million acres. And if we do, then we're going to be in a similar situation of ending stocks. It'll be 3-point-something to 4 million bales of ending stocks if we only plant 11 million and have, halfway decent weather. There's a lot of assumptions between now and the end of the 25 crop, but the way I'm penciling it out early on is probably a continuation of the trading range of prices that we saw for this year. That is to say, from roughly 70 to 85 cents would be the trading range that I expect over the whole season. And typically the seasonal pattern of prices is we see rallies that begin around Christmas and kind of continue into the new year, and they'll peak at the season high of prices. So if I'm telling you that I expect prices to be in the upper 70s and making a run at 80 or even over 80, I would expect that to be happening in April, May, June at the latest. That's typically when those seasonal runs happen, those seasonal highs. And then in the latter part of next year, harvest time next year, I expect we're probably going to slide back into the lower 70s or under 70 cents, kind of the way we're doing now. That's the most reasonable thing to expect. So if somebody's planning on planting cotton, I really think you need to have some kind of plan to book prices, forward cash contract prices, and pull the trigger on those contracts in the first half of the year to get any kind of a price that's remotely going to cover estimated production costs. I think I'll just leave it at that, Matt. But if anybody else has any questions, I'd be happy to take a stab at it.
Very good. Thank you. That's some honest information that we need this morning. So we appreciate that very much. Yeah. Thanks for the extra effort getting on this morning as you're traveling too. We appreciate that. Sure. We're going to continue on. We've got a special guest today, Bryce White, Producer Relations Director with Texas Corn Producers Board is with us. So Bryce, can you hear me? And can you share your screen? Well, thank you for being here, and take it away.
Yeah, I don't have a screen to share because a lot of stuff I'm going to talk about happened last night at like 6 p.m. So I'm
very good.
just to quickly get a few things out of the way, I'm Bryce White. I work for Texas Corn Producers, which is both the checkoff and the association. There's a lot that's been going on with the checkoff, but we'll be sending out a big newsletter in the winter, so I'm going to let a lot of that get handled there. Everybody should be getting that, and it'll be available online probably toward the end of January. But in terms of the association side, a lot happened just this week. That's been a buildup to a really long year in the policy world, with a lot of farmers that are having tough times. I mean, John and Mark both covered it in terms of the farmers with cotton and grain. We've seen another year. This has kind of been a trend since 2018 to where the cost of production has been, keeping margins so tight with what prices are. And this is another year where we've been asking for a farm bill to be updated. It didn't happen. And Congress is having to come in at the last minute with some economic aid. And so even though prices were higher and stuff, since 2018, like there were some good times. A lot of times cost of production was so tight that it didn't work out. And we're now kind of on, at least in Texas, we've seen 3 years of some guys having really tough years between weather-related disasters and then just economic disasters is what it's been called, as an economic aid stuff. And so the bill that is supposed to deliver aid was released last night. There was a lot in that, but if it passes both chambers and gets signed by the president, which it seems like it should be at this point, then I think by Saturday or so, everybody should know that there will be help coming on the way. This is really important because we were hearing that there were a lot of guys that weren't going to be able to get finance to actually farm in 25. And so as we kept going up to DC, as we kept having phone calls, Zoom visits and everything with a lot of members of Congress, we told them that this wasn't something you could just, wait for a new administration, new Congress and try and figure out then. Like, this is either now or never. And so we're cautiously optimistic about the economic aid relief that's going to be coming. We're incredibly thankful to pretty much all of Texas delegation. We had two of our representatives down in y'all's area that are Democrats, Henry Cuellar and Vicente Gonzalez. They were two of the first Democrats to sign on to the marker bill for this aid. And they helped recruit a lot of other folks to make it a bipartisan thing to get help. And by the end of yesterday, we had about 25 of Texas's 38 members in the House co-sponsoring the bill to get help. And so some of them, like Mark Veazey, that don't really have ag in their district, they all just came together to help the farmers in Texas. And so we're incredibly thankful to them. It was kind of nice to see after a long election year. But in addition to the economic aid, they did extend the farm bill, including some of the orphan programs that they have to go back for. And so if it gets signed, those will be extended through 25. And this has been a thing that, as I was referring to earlier, since 2018, that the 2018 Farm Bill only covered so much of what farmers were needing for some support. And we just saw this trend that keeps happening to where we keep seeing ad hoc assistance coming. And that's something that farmers don't like it. We don't like it. It's always tough to get through politically. And it's been time since they used cost of production numbers in the 2014 Farm Bill, and they just keep using those and extending them. This trend keeps happening. And so we fought very hard this year, for the last few years, but especially this year, we fought really hard to get the price supports increased, the reference prices. If you do Title I PLC, getting those increased. And it's been really challenging. We're hopeful for next year that we can get something worked out. But it's just a good reminder that, all the producers, all the farmers that watch this, that you really should be talking to your member of Congress, because it makes a difference. One member that specifically for the district I'm talking to, Michael Cloud, he's one that is a very fiscally conservative guy, but he also cares a lot about the farmers in his district. And he even came out helping with this, even though it generally goes against what he likes doing funding wise. And so And that's because producers in his district had talked to him a lot. And so I think that that's just the farmers that watch this are a really good example of how you should be staying in contact with your member and the difference that it could make. In addition to the farm bill getting extended in the disaster aid, there are a few other things in the bill that were extended that'll be good. One of them is the feral swine eradication program that specifically it's been in a pilot project kind of areas for the last 7 years, but it specifically is in Sinton and B County. That one got extended too. So for those that are using the resources for that, those should still be available in 25. And then they added another thing in this bill that should make E15 year round be available. I'm not entirely sure that is going to grind a whole lot more corn right now, but it's at least some. And so aside from the disaster aid, one more thing that we're really expecting to hear by the end of this week is the USMCA dispute panel with Mexico regarding the GMO corn ban that they had. That dispute panel has wrapped up their findings, and they should have a report out. When the report comes out, there's a 45-day period that Mexico and the United States get to put their heads together and decide, are we going to retaliate against what they've done to our corn, or are they going to drop it? And I'll say with the incoming administration, I think that we're a little more hopeful that Mexico would find a way to drop it, or then it will be the thing that ignites a trade war. And so we're hopeful that something beneficial can come from that, and that we can kind of stop some of the GMO corn, I guess, tension that had built up between us and Mexico. That's something that when we've talked to a lot of buyers and stuff in Mexico, that it's really not something that their people care about. It was something that just some powerful folks in their government cared about. And so we're still pretty hopeful that can come to a happy ending, and something that we're hoping we can hear by the end of the year. But those are kind of the big policy things that I'd expect to hear, I'd say in the next, week before Christmas. Other than that, we're looking forward to 2025 and hopefully having a good year in terms of the policy front. But Matt, Bobby, that's kind of the big update that I had for y'all today.
Very good. Thank you. Appreciate you being on this morning. We appreciate all our guests this morning being on and providing some really high level information as they do every month. Thank you very much. Bob, you got anything you want to add?
Oh, no, it's again, really good information. Appreciate Bryce being on this morning. I have kind of one question for the economist. Are y'all doing analysis such with as you do with corn and soybeans with cotton, grain, sorghum, and corn?
Yeah, Bobby, maybe a little more specifically what?
Well, as you compare plant soybeans, plant corn, according to economic status, have y'all been running any analysis to how those three shape to some degree of one might be little better than the others? I know here we're going to plant corn and corn, cotton, and grain sorghum, but is there any of that kind of correlates to one might have a little better chance than the other, even though they all look kind of
Bob, this is John. Yeah, we do take account of feed grain prices and cotton prices, and just in making prediction of acreage, what might get planted. I've got a slide that I use, a chart that I use that kind of shows the relationship between the ratio of corn prices to cotton prices, how that influences the planting of cotton acres.
Yeah, were you able to catch that, Bob? That Dr. Robinson does use corn and cotton price relationships that have a strong strong correlation between those price movements and planted acres of cotton. When it comes to grain sorghum, that's a little harder. Corn has encroached, and soybeans have both encroached a lot of our historical grain sorghum acres from Kansas, all the way down to Texas. We're planting a lot more corn in grain sorghum country, corn and soybeans up in Kansas. So that one's a little tougher. One of the best predictors for wheat acres this year is the price of wheat last year. And so even though there's no correlation between last year's price and what next year's price is going to be, it's a kind of an equal chance of up or down. Farmers still, that's a big influence. Just looking at last year's price makes a big difference on kind of what you're going to do next time. So those are kind of some of the factors that we do weigh in for wheat. Corn and soybeans is a pretty clear relationship, as Dr. Robinson mentions, cotton and corn. Grain sorghum, that's a little tougher. Grain sorghum many times is also influenced by our weather outlook. If it looks like it's going to be a dry year, kind of lean to a few more sorghum acres. We'll plant a lot of grain sorghum after we lose a cotton crop. So those sorghum acres can fluctuate pretty significantly based on outside factors than just the fundamentals of the grain sorghum market. So that one's a little tougher. But corn is the elephant in the room, driving much of U.S. agriculture, and obviously its impact on wheat prices, on cotton acres, as well as soybeans.
Very good. I even understood what you said, so that's a start. Anything else, gentlemen?
Does any of our guests have a question?
Well, Merry Christmas, guys.
Merry
Great to be
Christmas,
with you.
everybody.
Appreciate it.
Thank you for being here. Thank you for making it a great year. We'll see you soon.
Thanks for doing this.
Have
We'll see you.
a Merry
Merry Christmas.
Christmas, everyone.